to a large borrowers. Private equity. An alternative investment class and consists of capital that is not listed on a public exchange. Valuation services. Valuations of business, tangible assets, intellectual property, intangible assets, stock and securities, ESOP and private debt instruments. Financial advisory services. Primarily focused on providing advisory services in the areas of corporate finance, capital structuring, transaction advisory and M&A. Credit rating advisory. Our team's experience can bring in immense value by getting the desired rating upgrades or saving them from downgrades by fine-tuning the strategy. TEV study and DPR report. Evaluating the technological feasibility and economic viability of project to finding out the degree of risk involved. Insolvency services. Assess the financial position of the firm, partnership, LLPs and individuals, in several instances and try to save their business. Training. We are a pool of senior banker, academicians and professors specialized in all kinds of soft skill training. We are specialized in solving your all types of financial needs.
Virtual session on the emergence of venture debt as an asset class. Know your speakers. Mr. Ashish Agarwal, Director, Resurgent India Limited, Chartered Accountant and Management Graduate. Ashish Agarwal has a rich experience of more than 25 years in financial sector. He has an extensive knowledge in credit and investment banking, corporate finance, capital market operations, foreign exchange services, debt syndication, wealth management and financial advisory services. Mr. Ankit Agarwal, Director, Venture Debt, Lighthouse Canton. As Director, Venture Debt at Lighthouse Canton, Ankit Agarwal leads the venture debt strategy. Prior to this, he was an investment officer with International Finance Corporation, IFC, the private investment arm of World Bank Group in their manufacturing, agribusiness and sector division in South Asia. Mr. Arijit Sarkar, Director, Credit, Trifecta Capital. Arijit brings a diverse set of experiences to the firm and its portfolio companies, having worked across multiple domains in financial services, healthcare and retail. His investments at Trifecta Capital span across healthcare, mobility, education, consumer brands, fintech and B2B services, both e-commerce and SaaS. Mr. Aditya Mathur, Associate Director, Innovane Capital. Aditya is an Associate Director at Innovane Capital where he is responsible for sourcing, evaluating, and executing venture debt transactions. Before joining Innovane Capital, Aditya spent more than 5 years in corporate finance and treasury across IT/ITES and retail sectors. Mr. Ankur Pandey, Chief Manager and Head Startup, State Bank of India, a banker with over a decade experience in various domains of banking. Skilled in treasury management, derivatives, treasury sales, startup banking, corporate banking, business development, branch banking. Mr. Vivek Jain, Director, Stride Ventures, identifying opportunities and startups for investments, underwriting of investment proposals for IC approvals, strategic alliances with VCs, banks, investors, corporates, and other institutions.
Yeah, good afternoon, friends, or rather good evening now. So first of all, I would like to welcome all of you in this panel where we are discussing on the venture debt as an asset class or an alternative asset class for the startup. So I have my colleague Ojas. I think he'll run the small presentation which will give you the outlook of the industry about the venture debt in the country or the whatever the venture debt the players are there, how they assess the venture debt requirement of the startups. So over to you, Ojas.
Thank you. Thank you so much. A very good evening to all the panelists and the viewers. Let us start with the presentation on the topic Emergence of Venture Debt as an Asset Class. So few topics we are going to discuss today, which are growth of Indian venture debt, future outlook, venture debt versus traditional debt, benefits, what benefits venture debt provides to multiple stakeholders, what is the appropriate time for raising venture debt for any startup, and finally the use cases of venture debt. So let us focus on the growth of venture debt during the last few years. So we can see now calendar year 22, almost 100 to 120 venture debt deals has happened in the startup ecosystem in India, which has grown significantly in the last 3 years. Although COVID had an impact on the venture debt ecosystem as well, where we can see around 58 deals happened and the average ticket size was also on the lower end. Now, fintech sector was the most sector which got a lot of venture debt funding, and B2B SaaS and consumer followed by fintech sector. In the next 12 to 24 months, we expect 66% of the funding going into fintech, consumer, health tech, SaaS, and logistics. So these 5 sectors are going to be most attractive from the perspective of venture debt funding. Now, if we compare the venture debt with the traditional debt, so the purpose, venture debt is typically used by companies that have already raised equity funding and have achieved a product market fit. Traditional debt, it's generally used by companies to fund the day-to-day business such as working capital and finance major capex. Venture debt is riskier because the startups are they have a high risk and they have a limited operating cash flow. On the other hand, traditional debt is usually secured by a lot of collateral. Interest rates for venture debt is higher because more risk, more return. Traditional debt, it is lower because again, it has a backing of collateral and it is less risky in nature. Then repayment, venture debt can have flexible payment terms depending on the business model, depending on the cash flow needs of the company. And traditional debt, it is paid over a fixed course of time, usually with regular monthly payments of principal and interest. Key considerations while evaluating a startup. What all factors you should consider, a venture debt fund should consider while evaluating a startup. A company should have a reasonable runway when are preferred when evaluating companies for venture debt. Companies should have a high growth potential, and sectors that attract more venture capital funding or equity funding also sees high flow of venture debt investments. Venture debt has benefits to multiple stakeholders. Let's cover one by one. For founders, it extends the cash runway of a business. It fulfills the working capital requirements of the company, and it also assists in funding the capex expenditure. For venture capitals, they get a growth partner, banks on board, and venture debt, of course, complements equity financing and it helps with less dilution. Limited partners, they are getting a good rate of return. The holding period is relatively lesser than the equity funding, best of both worlds, and this provide a lot of access and awareness. Appropriate time for venture debt financing. When should a startup go for venture debt financing? When a company has demonstrated market traction and they have already achieved a product market fit and are generating good revenues. When they are backed by significant venture capital funds and private equity funds, when the companies have a clear path to profitability, and if they have capital intensive operations, they can go for venture debt to use fund equipment purchases and R&D expenses. And finally, for the acquisitions or mergers. Now, what is the appropriate stage for a venture debt financing? So we see that growth stage and expansion stage, which is Series B to Series D, has witnessed 70% venture debt across growth and expansion stages. And that's very clear because Series A, early stage, most of the companies are yet to achieve the product market fit, and it is a relatively a risky stage. If I talk about late stage, Series F and pre-IPO, then a company or a startup becomes more accessible to bank lending. Then use cases of venture debt, working capital management. Working capital get blocked in inventory, and there for that purpose, startups and companies can use venture debt. Acquisition financing, receivable financings, runway extension, order book discounting, convenience in taxation, and onward lending. These are the few use cases for venture debt financing. We have a handful of venture debt funds, major venture debt funds in India, namely Trifecta Capital, Innoven Capital, Strides Ventures, Altiria Capital, Anicut, Black Soil, and Lighthouse Canton. Now, coming to the future outlook of Indian venture debt, we see that it is still at its very early stage, and only 3% of the VC funding is equal to venture debt. But over a period of time, we expect this number to touch a $10 billion on an annual basis, and this should reach around 8 to 10%, 8 to 10% of the total equity funding happening in the companies. Thank you.
Thank you, Ojaswa.
Ashish Agrawal.
Thank you, Ojaswa, for the nice presentation and the giving the outlook of the venture debt industry. So, friends, I would like to once again welcome all of you in this webinar, where we are going to discuss the detailed on the venture debt industry and how the startups can approach to the venture debt funds or raising funds. So, you know that we have the panel, all the young dynamic leaders of this industry are there. Those have experience in the different industry, banking, and now they are part of the venture debt journey of venture debt industry. So we will listen their views, how they are thinking about this industry and whatever has been done in the past. So we'll try to cover up some examples also, where we can learn that anybody want to raise money or through venture debt, what are the options available and what are the cost involved and what are the areas of concerns. Along with that, we have very senior bankers also with us. So the big daddy of the banking industry. So Mr. Pandey there from the SBI. So he'll also speak on the initiative by the large bank of the country or largest bank of the country on the debt side for the startups. Actually, it may not be the venture debt in the term which we are saying, but definitely it is helping to the startup in the debt side actually, and in other areas also. And there are government regulations also which are helping to the startups in raising debt, where the government has come out with some schemes like the guarantee scheme, the priority sector lending to the startups. So these are the I think the regulation which are helping or which will help to the banks also to come forward. The other banks of the country, they will come forward. They'll start taking exposure in the startup ecosystem also in the form of debt. But still, we have seen that in the presentation, the size of the industry in terms of debt is very, very less in comparison to the overall the venture capital or maybe the overall traditional debt in the country. But you see that our industry, this venture debt industry in India, venture debt, I think existence is not very old. We have, I think, completed 6-7 years in this segment as of today. And we have handful of the players who are here in this space as of today. But if we compare with US, I think they are doing this in last more than 40-50 years. And their size of the venture debt is very big in comparison to Indian market actually. So as we have seen in the presentation, currently we have, I think, not more than 2% or 3% of the overall BC venture capital funding size in comparison to venture debt. But in US, it is more than 10 to 15% of the overall venture capital funding. So I believe that there is a scope, the big scope for the venture debt funds, and there is a scope for the startups to raise debt and to grow further. And the traditional banks or the banks like SBI who are taking initiative, they will also come forward and they will take the initiative to fund these startups actually. So so we have very esteemed panel, and so I'll invite Mr. Ankit Agrawal, who is the director in Lighthouse Canton. It's a fund which has started in the venture debt journey now, and basically they were into equity. And Ankit has very good experience of working in the large DFI or the large institutions like IFC and GIC, and then in India in Piramal Fund also. So he has experience of both the side, the equity, and now he's taking the lead in the debt side also. So Ankit ji, first of all, I would like to welcome you and thank you for joining with us. And Ankit has joined us from Singapore actually. So that's another this thing that the technology now playing such a big role that we can be anywhere, but we can be the part of any panel also. So Ankit ji, we would like to understand from you. I think first of all, what is the venture debt fund which the Lighthouse is running actually? What is the theme? What is the mandate of your fund? And then I think you can give us some idea about the startup or the entrepreneur who want to go for the venture debt funding. What is the right time for them actually? At what stage they should go for the raising funding through the venture debt? And whenever anybody is coming to you for raising venture debt, basically what do you see? What is the hygiene? What are the hygiene factors? What are the criteria which you generally keep in mind whenever anybody is approaching to you? So I would like to invite you for your deliberation. Over to you.
Yeah, thanks a lot. Thanks a lot, Ashish, for having me as part of this panel, and I'm quite happy to be part of a very set of experienced individuals in venture debt. So, brief introduction, about our fund. We launched our fund only early this year. Overall, it's a $100 million fund, and the reason I say it in US dollar million is because it's a cross geographical fund, wherein our focus is both India as well as Southeast Asia. And the reason for having such a fund is just to address, one of the points that you mentioned in the presentation, that today you would see that a lot of companies, startups especially, they have a holdco opco structure in Singapore and India. And oftentimes you would see that a lot of these companies, given the number of venture debt funds that are active in India, don't have, have easy access to capital, but offshore is where they really struggle. So that's one of the objectives for us, which we are trying to solve. And the second is obviously today a lot of Indian startups themselves have become more ambitious in terms of their expansion plans in the region. Naturally, after India, for them the next region is Southeast Asia and Middle East, and that's where they always need some US dollar capital as well. And therefore, our idea was to partner with these companies in both of these regions, India as well as Southeast Asia. Generally, therefore, what we've seen is, for any company who's growing, to address your question, what's the best stage to raise venture debt? The best stage is today what we're seeing is companies have started considering debt capital, right, from an early stage. Obviously, the different capital structures are being followed at each stage. For example, up to Series A stage, a lot of companies have started taking from revenue-based financing. So they started filling the gap, for companies who are at an early stage and may not qualify for venture debt. Whereas what we've seen is venture debt funds are generally more active from Series A and above stage up to pre-IPO, up to when, banks take over. So generally, companies today, irrespective of which stage they are in, have started taking some form of debt. Because the need for capital is always there, even if it's for an early stage company, correct? If it's a fintech company, if it's an e-commerce or D2C company, it does have requirement for working capital. And oftentimes for these early stage companies, equity is much more expensive, correct? Because they don't have a lot of equity capital to use it for all of these purposes. So the right time to start factoring debt, although at a much more measured level, is right at an early stage. Obviously, the nature of debt should vary and depending upon the size of the company. Now, there are various factors, that we as a fund look into, which are again not very different to what you mentioned in the presentation. Oftentimes you would look at what's the quality of equity capital that the company has raised, not just quality, but also quantity. How is the unit economics, at a gross margin, CM1, CM2, CM3 level? And then, of course, what's the cash runway that the company has? And finally, what's the need of the debt capital? What's the purpose for which the company is borrowing? Is it for working capital? Is it for, let's say, if it's a fintech company, for onward lending? So therefore, all of these together determine that what's going to be the optimal transaction structure.
Okay, great. Thank you very much, Ankit. I think you have very well defined the approach whenever anybody want to approach to venture fund, at what stage they should approach, and what are the factors which are generally looking for. So I'll come to you again after some time. And friends, now we have Mr. Aditya Mathur. He is from Innoven Capital. Innoven is the father of venture debt in the country. Actually, if you see, they started first, and they're part of now the Temasek Group actually. So welcome to Aditya ji for joining with us in this webinar. So we would like to understand first the mandate of Innoven on the venture debt side, and what is the progress which you have done till now. And then we would like to understand from you what factors are contributing the exceptional growth. We see the growth of this venture debt, I think, growing every year actually. So what are these factors in the exceptional growth in last few years in the venture debt side? And then another question which we would like to understand from you, that this how it has evolved actually in over the years, because you have the best experience of this venture debt segment in the country. So how it has evolved in last 7, 8, 10 years, and what are the customized solution which have been developed or we find out. And the last question we like to understand, if there is any economic downtrend and all, will it impact of the venture debt industry or the availability of the funds to the industry or to the startups? Over to you, Aditya.
Thank you. Thank you so much, Ashish. That was a very kind introduction. Thank you so much for that. So yes, absolutely. As you mentioned, Innoven, our team, we have been doing venture debt since 2008. Right, that was when it started, and in 2014-15, Temasek came in. They have been really the backers of Innoven and expanded it to Southeast Asia and China. So since 2014, we have been a pan-Asia venture debt fund. Right, and in terms of our mandate, so we started back in 2008 as an NBFC. That is, our core. That was our core vehicle, and we expanded that, took on bank leverage, scaled that NBFC significantly well. And in 2021, we set up a venture debt fund also, right, which is a typical category to AIF, a 200 million in China and Singapore. So even from an India standpoint, we have a fund, $200 million fund, plus this NBFC is there, which also has net worth of over $100 million. So we have these two vehicles, and the core long-term conventional venture debt, which your colleague explained this in the slides, right? That long-term venture debt we do from our fund, and the NBFC is now purely to support working capital requirements of our portfolio companies. Coming to what has really contributed to the growth of this asset class, I think it's a function of how the equity has increased in depth, right? So even 6-7 years back, if you are a startup founder, getting a VC investor to write dollar check to you to back your idea was a big win in itself, right? Not anymore. Today, if you are a smart founder, if your idea has, even a little bit of legs in it, there are easily 24 investors you can reach out to who could be interested, who you can explore and, seek investments from, right? So for the longest time, getting an equity investor was pretty much the win, right, of fundraise. Today, for last 4-5 years at least, that's not really the case. Most good founders know that there are enough keen investors out there. And hence there is focus on how can I how can I raise capital in a more dilution sensitive manner, right? So when I'm not feeling insecure that, hey, will my idea even get a penny of funding? When that insecurity is taken care of, now I'm thinking, okay, how much do I need to dilute? What sort of capital do I need to raise, right? So that depth of early stage investors has certainly helped founders feel a lot more comfortable with their fundraisers, and add a layer of debt to it to ensure they reach their runway and the milestones without with a more dilution sensitive manner. Right. So that, and there are, and of course, as the ecosystem has matured, right? So Innoven itself has funded 220 plus startups, right? A lot of founders in future startups came from one of these early ones, right? So Flipkart itself has resulted in probably 24 different startups, right? And same goes for all the big players, right? So a lot of founders that have started up in last 5-6 years saw larger enterprises take debt, see the benefits of that, and clearly they know from very early stage that, hey, this concept, this asset class makes a good sense for me. And in terms of how the product has varied, as Ankit also mentioned, now that there are a lot more nuanced solutions. So there are solutions like revenue-based financing, which is for very early stage companies where a VC equity funding might not have happened. These companies might be at a seed level and they might require 6, 8, 10 months of support. So that is there, of course, between us, what we do at Venture Debt, there are all sorts of constructs here as well. We all work on working capital solutions as well for our portfolio companies. And, every now and then, and we hope to see a lot more of, conventional banks coming in, especially on the working capital side, right? So that's been very encouraging. As well as, some of those requirements have evolved, especially for D2C and B2B enterprises. I hope I covered it well. And you asked one more thing, downturn, right?
Correct.
So I'll just take a stab at that also. So of course it's negative, right? We certainly, it doesn't help if there is a lot of pessimism, a lot of worry in the ecosystem. But things go in extremes. 2021 was one kind of extreme. 2022, or where we are now, is another extreme, right? In a 2021 kind of a scenario, so while there was a huge volume of companies that raised equity capital and there was a lot of deals for us to fund for venture debt as well, but the valuations were so far ahead, right? So were so out of sync that for founders, optimizing dilution was not very important, right? If as a founder, if you know you are raising at a 3-4 year forward multiple, right, you are okay, but hey, fine, I'm getting at a, I was seeking 500 mil, I'm getting a $1 billion valuation. Now, do I need to really optimize it by taking some debt and so on? In more normal times, in more steady times, founders are of course concerned and lot more deliberate on how they want to dilute their ownership. So some environment like 2022 and now, we seek a lot more inbound interest as equity becomes tough and expensive to raise. But of course, there would be some credit challenges we all will face as raising subsequent funding will get tough for a lot of startups.
Great. Thank you. So I think the one major factor which is helping to raise venture debt is the less dilution for the founders actually, which
Oh, absolutely. That is the
for
core.
yeah.
Absolutely. I think that's the core use case, the reason of existence, that the founders of tech enterprises, startups, as we call them, will continuously need to raise capital, especially in the initial part of their journey. And venture debt allows that to happen while keeping dilution in check.
Correct. Good. Thank you, Aditya, for your deliberation. So, friends, now we have Mr. Arjit Sarkar, who is director in Trifecta Capital. Trifecta is also an old name in the industry in venture debt. They, I think, already have 2-3 venture debt funds now. They are into equity fund also. And Arjit, first of all, welcome to you and thank you very much for joining with us. So we would like to understand from you the basically the inherent limitations and the potential downsides of this financing model, which the founder or the entrepreneur should know actually. Because when we are talking the growth, the positive side, we should also discuss the whatever the limitations are there. so which should be kept in mind. And then you have the journey of 4-5 years in this segment. So you have more than 100 companies, and so you can share some example or some maybe case studies which might be helpful to the participants, maybe at a different stage whenever the startups are coming for the funding, and also what kind of use cases are there. So over to you, and thank you very much.
Thanks, Ashish. Greetings to everyone, and thanks to my panelists also. A lot of insights already. So I'll try and keep it brief. I think like you said, Trifecta Capital has been around for some time now, more than 7 years. We are in the middle of our third fund, which is a $250 million fund, and like you said, we've also launched an equity fund, which is another $250 million fund focused on late stage investments. We also have another vertical which actually works with CFOs and the finance function of startups to help them strengthen their businesses, manage treasuries better, and bring a little bit more science and more process to the finance function, which often startups do not focus on as much. So I think our goal at Trifecta Capital is to help support startups across different elements of their financing requirements. And venture debt is how we got started, and it's a key part of our business. There are definitely positives and negatives when it comes to venture debt, and what I think a startup founder should look at when it comes to evaluating different forms of financing. The biggest thing about debt is, unlike equity, debt has to be paid back, right? So it has to be returned to whoever is investing that, which means that the startup has to have some visibility as to how that is going to happen, right? If it's not just a matter of taking money or taking capital, the founder of the business has to think through very clearly as to what is the plan to return that capital. Now, and that's why I think most venture debt players, we finance businesses and with certain requirements in mind, right? So when we, like Ankit said, we look at unit economics, we look at the kinds of equity investors in the business model itself, and how amenable it is to debt, right? And as well as maybe some of the use cases for which the company is raising debt. All of these come together to help us define whether the company can actually return the capital, and that goes into our evaluation. So, for example, if a company has a very, I would say, a predictable use of the capital, right? So, like working capital, which we know that if a company needs to finance receivables or inventory, that is a 2, 3, maybe even a 6-month journey, but then that will be returned to the business, and they can use those flows to repay the debt. Or there could be slightly more longer term uses of capital. For example, a company might be looking to make acquisitions or finance inorganic growth, where they're looking to buy out a few smaller players. Now, those acquisitions might be actually accretive in the sense that the cash flows generated from those acquisitions will help in financing the repayment of the debt, right? So these are some kind of use cases or case studies, like you said, where venture debt is uniquely suited, right? Where a company does not have to use equity capital. Because as a panelist had said before, equity capital is very expensive, and while it is more easily available today than when we started 7-8 years ago, it's still limited, and I think the requirements from companies in terms of the different areas where they need to deploy capital are still many-fold as compared to the availability of equity capital. So venture debt, and more broadly, any non-dilutive form of financing, helps support businesses as they're looking to finance different use cases. I think another, I would say, key, not really downside, but thing to keep in mind while taking debt is how the interaction between investors and debt holders in the business is going to be if the business is not growing or not able to deliver the kind of promises made to investors, right? So at that point of time, it's important to remember that debt has a very different kind of claim on the business as compared to an equity investor. And hence, it is very important to choose your partners very, very carefully. Because a debt investor, like we also have, esteemed panelists from SBI. So a bank also has a certain kind of perspective when it comes to enforcing security and trying to get recovery. I think venture debt funds of different kinds will each have their own kind of mechanisms and ways in which they will try to recover whatever is possible if the business is not able to return the money as per the agreed schedules. So it's important to have a partner who is both supportive and, more importantly, predictable. So you know that how they behave, what are the kinds of mechanisms that they use, what is their relationship with the equity investors as well. Because when things are not well, that's when everybody really has to work together to make sure that the business is can be salvaged. And so those are some of the softer elements. So we do encourage all our founders that while you look at elements such as interest rates and tenors and repayment structures, also look at some of the softer elements, which is how well do you gel with your venture debt partner, right? Have you built a solid relationship? Are you confident as to how they will behave? So I think these are two things to keep in mind, that venture debt has to be paid back, and if it is not, if the business is not able to pay back, then certain actions will happen, and you need to know what are those actions and how your partner will behave. So that's, I would say, the the not so talked about side of venture debt. When it comes to use cases, I mentioned a few: working capital, capex, inorganic growth. Apart from that, I think we do see companies looking at especially in specific sectors. For fintech, for example, companies use debt capital as a way to begin their liability relationship as they are scaling up their lending activity. Often, more mainstream sources of capital like banking partners or NBFCs are not able to participate early in the journey. So at that time, a venture debt partner can come in and help seed the liability side, build up some track record of repayments, and then they gradually graduate to more traditional forms of financing. So yeah, that's
thank you, Arjit. I think thank you very much for nice deliberation, and you have rightly told that I think nothing is different. Whatever we have to look in the traditional debt also, the repayment schedule, interest and interest payments, and the whatever the I'll say the other covenants are there, which anyway we have to see in any financial transactions. So in the venture debt also. But one more thing which I think I would like to highlight here, and all will agree also, this, I think there is some component of warrant, which is I think a very important part of the venture debt in most of the cases. So if you can highlight on that part, basically what kind of warrant, what kind of dilution, or what kind of basically the upside there in these kind of transactions.
So see, venture debt works with businesses who are very, very young, and I think in many cases the business model is not yet very mature, right? So the kind of risks which a venture debt fund or a venture debt partner takes is, I would say, probably a little higher than most SME lending businesses would be taking, right? Because a lot of these companies are not yet generating cash flows. They are still negative in terms of their profitability. So that risk, there are two ways to compensate for that, right? One is you can charge exorbitant interest rates, right? So if a debt provider is charging 25-30% interest rate, that is placing a lot of burden on the company to service interest and very high cash outflow requirements, right? Which is, again, it becomes very difficult for young businesses to do. So venture debt, has actually, and this is not just Trifecta Capital, this is across the industry. In fact, for the last 30-40 years, venture debt has tried to solve this by saying that, the interest rate shall be kept at a manageable level. Broadly, the entire industry works at a certain level of interest rate. But what we will try and compensate for that is by taking some participation in the upside. So the companies which are doing very well, we do take a very nominal, small portion of equity options in these businesses. And what ends up happening is the companies which are doing very well, they do return some upside, which helps compensate for some of the companies which don't do so well. So in terms of amount, this is not at all comparable to the kind of equity you would have to give to a venture capital provider. This is, of the total amount of venture debt provided, a small portion of that would be provided as options to the venture debt partner. So, and that number varies depending on the structure of the debt and the repayment schedule and all of that. But it does help align interests, and also keep the cash interest rate overall low. So the venture debt fund is also then invested in the growth of the business. It's not just looking I'm making a fixed interest rate, but they're very incentivized to say, how can I support this business grow to the next level? Because that's when my equity option is much more valuable, right?
Great. So you are saying that warrants are there, which are helping in upside and lowering the rate of interest.
That's right.
What is the percentage of warrants in the overall debt component?
So,
you can...
Unfortunately, I think this percentage of warrants has become a way that startups look at it. So that number can vary, right? It can vary from as low as 4-5% all the way up to 15-20%, depending on the market and the use case. But I think I would encourage startups to think of it not just as a percentage of the debt amount. Think of it as for the debt amount and the period of time that you have received it and you're able to use that money, right? That is more important. It's not just a percentage of the amount, but like if you're getting a loan for 3 years or 5 years versus a loan for 1.5 years, the kind of warrants that you can offer for that longer term capital is actually higher. So think of it as a more holistic number, not just as a portion of the debt. Portion of the debt, like I said, it varies. But more broadly, I think it's a number which should add at least, to make it meaningful for the venture debt partner, it should add at least 1/4 or 1/3 of the returns of the business for it to be meaningful and for it to actually align interests of everyone around the table.
Great. Thank you very much, Ajit. Thank you for your nice deliberation. So friends, now we have Mr. Ankur Pandey, who is the Chief Manager and Head of Startup Branch, SBI, the first branch in the country. So first of all, congratulations to Ankurji for starting the journey with the first branch of the SBI on the startup side, actually. So I think it's good that you are taking that initiative. Ankurji, we would like to welcome you and thank you for joining with us also. So we would like to, I think SBI is the largest lender in the country and we have the oldest bank also in the country in terms of size and the journey. So you would like to, I think the one is the regulation part, because you know that the government is or RBI is doing a lot of I think regulation easing for the startups. Where on equity side we have seen that a lot of AIFs are there, venture debts are there, but for the PSU banks or the banks in the country, what are the easing out the regulations in terms of the PSL book and the guarantee schemes and all, which will be helpful to all the audience who understand the regulation on the debt side. And other than that, that you can just give us the idea about the startup initiative of SBI. Actually, anybody want to in the startup space and want to approach to SBI, how they can approach, what kind of services you are offering to these people, and then we would like to understand the how this venture debt is complementing to the traditional debt, the traditional way of financing actually. So whether they are competing to each other, or they are complementing each other basically. So, and what are the areas where the banks can help to the startups, entrepreneurs in their journey through the debt part actually. So over to you, and thank you very much, sir.
Thank you very much, Ashish, for having me here. So what I'll do, I'll start with first about the initiative of SBI, and then we'll cover the regulation part and how to go forward.
Correct.
See, as everyone knows, we are one of the largest lender and oldest bank in the country. Started in way back in 1806 as a Bank of Calcutta, and we had our own journey. And there have been multiple, you can say, the mergers in between, acquisitions, and finally 1955 the SBI came into the light, and in the present form we merged all our associate banks in 2017, and now we are operating as SBI as a bank now. So what happened in this journey, and how the SBI traditional banks function? We have been since legacy bank, you see that we have three verticals in bank, mainly to cater to the needs of different kind of clientele. Starts with the retail and digital banking or one vertical, then CCG vertical, as well as the CAG. So the CAG and CCG vertical takes care of only to the, you can say, the credit customers and large credit corporates, the limits of 100 crores and beyond. And our RNDB vertical, retail and digital banking, takes care of the individuals, personal and non-personal banking, for side of, you can say, the credit limits up to 100 crore. So, and we have been a traditional lender. So when it comes to startups in 2016, when Government of India launched the movement, the Startup India program was launched. So at that time, all the banks and SBI as well as other banks have also come up with a plan and launched a few branches across the special branches to cater to the needs of startups. But the ecosystem was not mature. Especially on the equity side, funding was very much limited. Venture debt was there, but not. They were also, the presence was not felt that much at that point of time. And subsequently, in 2-3 years over the period, what happened? These branches were either merged or converted into regular banking branches. But when we see since 2000, means last 3, 4, or 5 years, not since 2020, 21, we have seen the ecosystem has matured slightly. Government has given a lot of guidelines, sort of policies have come up. There are a lot of changes which are happening continuously, and government is also involving with all the stakeholders of the ecosystem, not only with the startups, with the banks, with the policy makers, with the VCs. Now a lot of other things are coming up, incubators, excellence centers are coming up from government side. So it has promoted, and there are the certification which started by DPIIT, which is a must to avail certain government schemes. So what happens at that, when this DPIIT certifications have now crossed 90,000 startups, which are registered startups under the central government DPIIT program, and there are startups which are again registered with the state government programs, like in Karnataka we run a Startup Karnataka, we have, and similar kind of bodies which are doing the affiliations. So as a bank, we felt that with our interactions with the government, with the industry participation, with the industry bodies, as well as with the startups, that there is a need to, because startups have a specific requirement. They want a quick and services, which was not possible in regular branches. Now we were finding it a bit difficult to cater to specific clientele, let's say a young age entity. In our regular clientele, we generally deals with 25,000 to 50,000 customers on average. That is the average size of SBI branch which handles clientele. So then our chairman's vision was like, we have to set up a new series of branches and verticals which can cater to these needs of the startups, VCs, AIFs, as well as the, you can say, the stakeholders of the entire ecosystem. So we worked on it for around close to 2 years, and we launched this initiative and branch started from Bangalore in August 2022. So it's close to 9 months now we have been operational. And since I have been involved in it since beginning, from day one, from the scratch, we have built up the entire concept, the policies, the products, which some tweaking was required. We have done it. And then second branch we subsequently opened in Chennai, in IIT Research Park. And third branch now we are operational in Gurgaon as well. So there will be 4 more branches will be coming up in Hyderabad, Mumbai, Pune, and maybe in Noida and in the later stage, or you can say in the last of this. We also have a plan to go into tier 3, tier 2, and tier 3 cities and towns, we can say, with our specific startup desks across the India. And these desks will be inside the SME or commercial banking branches, which will cater to the needs of these startups at the branch level. And later on, whatever additional requirements are there, those will be catered by these startup specific specialized startup branches, you can say. So that is the structure and this one. So last 1 year I've been there in market. I would have interacted with more than 700 to 800 founders almost every day, meeting 4 or 5 people in Bangalore, because the market is huge in Bangalore and India everywhere. And this was one segment which somehow I think there were we were not able to associate with them. We were finding it means though there were some accounts with the bank and branches, but we were not a banker for them. We were not a preferred banker for them. There were maybe there may be various reasons for that. So what we did, we tried to bring in everything together now. So we as a SBI group, we operate from the branch. So we brought in all our joint ventures, our gift city operations, our foreign operations, put together, we form a team so that any startup who needs any help on banking part or financial services, we'll be able to offer from these branches within India, in gift city, and abroad, all 3 places. SBI has 23,000 branches close to in India, 200 plus offices abroad in 37 countries. Wherever the Indian businesses and Indian diaspora is there, we are present there. We have office in gift city as well. So now these branches, specifically these startup branches, cater to the needs of end-to-end solutions they offer to startups. Somebody who walks into branch like a basic service on incorporation of the entity till listing, IPOs and FPOs, whatever you require, these branches can fulfill your requirements. Definitely, the assessments are on merit and the bank takes care of it. If someone who fits into our criteria, definitely everything is available, for them. And it's a one-stop solution. So we are also LPs to some of the VCs and funds as well that the other even venture debt. Also, we maybe will look for wherever we can collaborate with them and work together. And when it comes to traditional debt, when we talk about it, startups, see at early stage of people, you can say until unless a startup has hit the market, it doesn't go. The debt doesn't go well with them because the debt has to be paid. And when it comes to traditional debt, it has to be served on a fixed and regular interval. If you're not generating enough cash in market, you will not be able to serve the debt at initial stage. And if you're not able to serve the debt, then your future prospects it's going to be really challenging for you to raise any kind of capital in market, because the banking debt, the moment you default on day one, it is categorized as SMA 0, SMA 1, 2, 3, and further end, classified as NPA. So it hits your company, it hits the directors. So startups have to be very careful when they go for when they think that there is a need for debt, they have to be very careful that they have to serve the debt. If it is a working capital from a bank, you need to serve interest on every month, and you should have that runway that you will be able to serve the interest. Then only one should go for the debt. Though banks are also very conservative in that, we see that now what kind of cash flows are there, and if the cash flows are not there, generally we also say that it's better not to go with the banks with the debt, because I may support you right now. You may work for 3 months, 6 months, or 1 year down the line, but at any point of time you fail to repay it, and you know that, and I also see that you don't have enough runway, you don't have the cash in hand, you're not generating cash flows, or your product, let's say there is some delay and you are not able to hit the market at right time. So then your future prospects of raising the capital are also not very clear. So once you default on the bank, then your entire credit history, everything goes down, and it may not fit into the due diligence of the VCs as well. Nobody likes to fund someone who doesn't have a clear track record or a good track record. So my suggestion will be to at the initial stages, and as everyone says that we are also looking for startups who have already raised some kind of capital. We are not working exactly on the venture debt model, but we are trying to work on similar things from where they want that the banks to come in. Definitely we can partner, we can complement each other. And on certain part where we see that there are good prospects, we do take up the startups, entities which are loss making. But if the path of profitability is visible to us, there is a difference that path of profitability visible to founders, visible to a bank. So I'll be very clear on that part. If we see that as a bank that the path of profitability is clear and people are moving on that, yes, we are ready to take the exposure, and we are being taking now also. And in traditional banking, it was a bit difficult because my entire assessment model and everything was tilted towards profitability. So through startup branches, we have devised some new products. We have come up with the new CRA models and assessment models so that we can work with them, we can generate. And now we also prefer that someone who is gone for B series funding, at least we should intern them. Or at the initial stage, if someone has a really good product and this one, and if the needs are very small and it can be covered under some government guarantee schemes like you can say under CGTMSE or CGSS, the new scheme, then definitely we can look into and we can cover it. When it comes to CGSS is the new central government scheme launched for startups. It's called a credit guarantee scheme for startups, where up to 10 crore the loans can be offered collateral free, but there are multiple riders on that. And there are multiple milestones when startup needs to achieve. And based on that, these loans can be sanctioned, but the assessment remains same. The overall cap on working capital requirement is as per RBI norms. And thumb rule for that is you should have if you are into a product-based company in manufacturing, you should have, the thumb rule says that maximum the working capital which I can fund is 25% of your annual revenue. And if you're into trades and services, then it is 15% of your annual revenue. So whatever model or assessment I do, my overall broad guidelines will remain same. Whereas a venture debt can take more exposure. They may be able to surpass these ceilings and limits. But as a bank, I am bounded by these rules. So let's say if an entity has been generating a revenue of 100 crore, in no case I can fund a working capital more than 25 crore. And we'll see the last audited financials, plus based on some of the projections for 1 or 2 years, and we will do. The other advantage with the venture debt is that there are certain things where you can amortize your repayment schedule and customize it. That is a bit difficult in the banks because again the RBI norms come in picture because we are a highly regulated entities and we work in a sector which is controlled by completely, you can say, controlled by RBI. So what happens when it's a working capital is the only good product which fits in for the startups. And I'll share my experience when I have asked some of the startups who approached us for term loans. It becomes really difficult for a bank because a term loan is a long-term product. When I see 5 years or 7 years product, and if I ask somebody to put a CMA and project your numbers for 5 years, people are actually unable to project the numbers. Or if they are able to, then there are a lot of gaps in that. So as a product, the term loan doesn't. Banking, you can say that for the banks, the term loan is not a right product which fits into the requirement of each startups. There may be some cases will be there where it fits into, but otherwise, as a working capital, yes, we can work on it. We are working with the multiple startups now in Bangalore, in other branches as well, and we can look for wherever the venture debt has supported some of the startups, and now they are exiting, and there is an opportunity. They are moving towards path of profitability. We can pitch in. Definitely, banking debt comes at lower price than any other kind of debt available in market, but there has to be some sort of security or comfort to a banker. So that is what we look into, and it may not be 100% collateralized or lending, but definitely some sort of collateral or Asian bank explores based on the policies and the business models and the relationship. That is more important, as other panelists have also said. That is very important how you keep your relationship with your investors, with your other partners, with the. And being a bank like SBI, see what will happen now. Your entire business cycle, if you see, there will be multiple vendors and stakeholders. And there may be 20 to 30% of your vendors, stakeholders, and others will be already banking with us. So the feedback which comes from them also is very important for us. And that also helps us in taking the decision.
Very good, sir. I think Ankurji have very well covered a lot of insights we have given from the banking point of view. 2-3 things which are very important, which you have told, that you are bound with the regulation where you cannot deviate from the whatever the rules are there in terms of assessment of the limit or the profitability, or maybe the other areas of this thing, covenants, which are, I think, maybe better. They may be getting the better covenants in the venture debt segment, but not in the banks. Maybe the startup might be going to the venture debt, and then maybe after reaching certain stage, they'll come to the bank. So they are complementing to each other. They are not competing actually. The question was whether they are complementing or basically competing. So this is good, I think, journey which will help to the startup ecosystem also. So thank you very much, friends. Now we have Mr. Vivek Jain. He is the director in Stride Venture. So Stride Venture is again a venture debt fund. I know Vivek since last more than 7-8 years, and so he has seen both the side. Actually, he was the banker throughout his life. 7-8 years, 10 years, he was in the banks like HDFC, IDFC, and other banks. He was working in the private banks, a traditional banker, and then he moved to the venture debt side. So Vivek, first of all, welcome to you and thank you very much. You are not, I'll say not this last but not the least actually. So first of all, I would like to understand the Stride Venture journey in terms of lending to the startups and all. Any case study which you can discuss also. Other than that, many times because we are investment banker, merchant banker, many people who are coming to us for funding, they're asking, and we are helping the many venture debt funds also, either in the raising fund also, or in the valuation of these funds, or signing of PPM, or certifying the PPM also. So people are asking the banks are raising money from the deposits and other sources. How the venture debt people are getting money actually? Which are the sources of raising money? Where the money is coming actually? So that's the one thing which I think the people want to understand. And whether this money is a long-term money or as a short-term money. So anybody who is in the ecosystem would like to understand on this part. And other than that, I mean, you are the banker also. So I would like to ask some hard questions from you in terms of the key terms of the debt actually. So there are 3-4 areas are there which are basically important for any debt actually. The tenure of the loan, the rate of interest is there, then the I'll say that security. So although Ankurji has tried to give the banking perspective, but because you have seen on both the side actually, so if you can cover on that part also, how the different from the banking, the venture debt actually. One thing came into the discussion that the flexibility of the repayment can be possible in venture debt actually. So all these things are which are the key elements of the venture debt. If you can cover up, that will be helpful to our startup founders who are basically part of this discussion. So over to you and thank you very much, Vivek.
Thank you so much, Ashish ji. And it was, large portion of the venture debt ecosystem has been covered by my fellow panelists already. But I'll take a step back and maybe talk a little about Stride and then try to cover the points that you want me to cover. So Stride as a venture debt fund, we started our journey in 2019. We are all ex-bankers at Stride, large, working with MNCs as well as Indian banks. All of them are private banks. So close to 16 years of banking experience across the managing partners and myself. And what we have done over the years within the banking ecosystem was that try to analyze the companies, try to structure products for them. But how venture debt is helping the startups, and we wanted to work for startups only. So that is where the idea of Stride came in, where we started our first fund in 2019, $70 million, which we raised, deployed across 30 odd startups with an average ticket size of 2 to 3 million. These were mostly early stage to growth stage startups. And then we launched a fund 2 in 2021, which was $200 million, which we closed last year, completely deployed. We have launched a fund 3, which is $300 million fund. We have already made a couple of investments from there. And so we are in our fund 3 journey, like trifecta. And what we have done along with this is that since we try to understand the issues that the founders face and these early stage companies face. So we have also created a small NBFC, which is not an AIF business. AIF business is regulated by SEBI and the NBFC is regulated by RBI. So there's a different NBFC that is there by the name of Stride One, where we try to help startups and their ecosystem. So on balance sheet lending, we do from the AIF and off balance sheet structures such as supply chain financing products we do from our Stride One arm. So what we are trying to create is a financial ecosystem for the startups, working very closely with the VC ecosystem and the banks. So like Ankur you mentioned, so we have done a couple of co-investments with the various banks into startups where we introduced these companies to banks also. So while we have been working towards the venture debt ecosystem and trying to create solutions, because there is no product, I would say, in venture debt. It's a solution that you have to customize for the startup depending on stage and sector that they are into. And so I'll cover the broad terms, maybe the structures first, and then we'll go to the LP discussion. So if we look at the structure, since it's a SEBI regulated fund, and always there's a LP advisory committee also which is there, and there are investment committee processes which every fund follows. So the repayment schedules, the tenors are generally the life of the funds are normally 7 to 8 years, but what we try to do is that there is a capital commitment period which is close to 4 years, 3 to 4 years largely all the funds have. So from an LP perspective, their capital commitment is for 3 to 4 years. So that is the reason venture debts, you will see that normally they try to keep their tenors below 3 to 4 years. That is the range that normally venture debt operate in, which is, and depending on the structure. So we do working capital structures where we try to match the working capital cycle with the predictable cash flows. And that is where maybe 90 days, 120 days kind of a rollover facilities you will see. Or in case of term loans, you will see maybe 15, 18, 21, 24 months kind of facilities, depending on the cash flows that the company has, or if it is an order-backed facility, or if it is some kind of a revenue-based facility, then it totally depends on what kind of predictable revenues the company has. So those are the tenors that are typically in their venture debt. So coming to security structures. So normally, since venture debt are generally the first lenders to the company. So there's an exclusive charge created over all the assets of the company, which is filed with ROC, and security enforcement can be done in case of delays or defaults. So venture debt is a secured asset class from an LP perspective as well as from founders and companies perspective. So there's a filing in the ROC which happens just like banks. And also in terms of repayment, so while interest is to be serviced on a monthly basis, there are I would say 1 or 2 instances in the whole ecosystem where someone would have asked them to pay interest at a later stage, or have bundled it with the repayment, principal repayment. But normally interest is serviced on a monthly basis, and principal can be amortized monthly, quarterly, half yearly. But there would be a very small outlier transactions of bullet repayments. But what we are trying to do as a venture debt ecosystem across all the funds is that we are trying to not to burden the company while making those repayments, but at the same time making it easier for them to remain compliant with the law. So that is how venture debt is operating largely. And in terms of LP interest, so like I mentioned that there is a monthly repayment of interest. So from a LP investor or investor perspective, if you look at Stride, so we are backed by one of the largest private sector banks. We are backed by sovereign fund, insurance companies, as well as corporate treasuries, listed treasuries, family offices, and HNIs. So what brings that confidence into a venture debt is obviously one, that what kind of analysis or what kind of security structure you have created in your product, and secondly also since there's a predictable cash outflow to LPs on a monthly, quarterly basis depending on the fund. So there is a fixed income which is coming to the LPs, while there's an equity upside in the form of warrants that is also available. So while you are trying to maximize the returns through equity upside, but at the same time you are also generating some fixed returns for the LPs. And considering that capital commitment period is short as compared to other longer tenure funds where you have a repayment at the end of the tenure, or the maturity is at the end of the 8 years, 10 years. Here you are looking at capital commitment of 3 to 4 years, and after that you are in the money already, and you can obviously get an equity upside during the life of the fund, which is generally 7 to 8 years. So that is where you would see a lot of LP interest coming in into the venture debt ecosystem.
Great. I think thank you very much for covering in detailed manner. I think it is very important for us to I think deliberate and discuss the all ingredients of the venture debt so that the people who are interested, they should know more about it actually. So we have many questions also from the audience, and we like to take some of the questions which have been raised. So somebody, Mr. TKS has raised the one question, which is basically what will be the top 3 eligibility criteria in seeking venture debt, especially for a startup that is yet to start traction, basically. So 3 eligibility criteria for any venture debt, I think that is the question. So if anybody would like to take it and give some idea on that. So any panelist would like to cover, take this question, the 3 eligibility criteria for any startup to reach venture debt actually.
I think the part which says yet to start traction, does that, I'm going with the implication that they still really haven't found a market and they are still trying. Right, they are still trying to see if there is the product market fit, but that's a very loosely put term, but yeah, they're still figuring out what they want to do, right, and how do they want to approach market. I think I would again, maybe I hinted this, when I was speaking. Equity is the core driver of the startup ecosystem, right? So let's not have any doubts about that, right? It's a high risk, high return, high mortality ecosystem, right? So of course, the core vehicle, core driver of growth is VC funding, right? You've got to have equity partners. Debt, you need, when you're thinking of debt, this should be from that comfort, as fellow panelists covered, that you should have some line of sight, hey, this will start to get repaid, right? You could have maybe some months of moratorium upfront where you don't need to repay anything, but 3, 4, 5, 6 months down the line, you need to start making these regular outflows, right? So if you're that early in your journey where you're still figuring out what I'll do, probably just hold on, from debt, right? Focus more on having equity really take you to that point where there is some comfort, and then of course, debt can come in, right? And if you're thinking of again raising a large round, right? We all have seen companies which are pre-PMF and still have raised massive rounds, right? Because of the founders or for various reasons. Then of course you can take debt as a part of it, right? But I think first and foremost thing is what you have to have good clarity, good position on what you have achieved on the product side with the equity that you have raised.
Got it. So you are saying that this equity is the important part whenever you are going for any debt raising.
Absolutely. Especially when you're very early, right? Especially when you're very early, pre-product market fit, you're still figuring out what you want to do. Equity is what is crucial.
If somebody is a bootstrapped and they have reached a certain stage and they want to raise venture debt, will it be possible to get the venture debt, or is it the equity the compulsory thing for raising any outside equity actually for raising any venture debt?
I think if you are bootstrapped and seeking debt, I would go that with the assumption that you're profitable, right? Because otherwise, or if you have your own wealth and you have been deploying that, right, where you're loss making yet bootstrapped, then I think venture debt, at least as much as Innoven really doesn't work, right? For us, gating criteria is presence of institutional VC, right? So that is like how we define our universe. Otherwise, sir, MSME, the whole ecosystem, right? How do you really define a startup, right? So for us, that gets defined by VC funding, right? But if you're bootstrapped and there are some profitability, I'm sure banks can do a great job. Right, even if a VC funding is not there, banks are great at underwriting, as long as positive operational cash flows are there.
Okay, so
just to add to this, I think there might be some confusion on what is venture debt, right? Venture debt is 2 words, venture and debt. So debt is just part of it, that a loan which you pay back, but venture is equally important. Venture means that there is an institutional investor. Without institutional investor, there is no venture debt. So, there is debt, which is banks and NBFCs and all of that. And that can exist for different kinds of companies, promoter-backed companies, cash flow generating businesses, all of that. But venture debt means that there is an institutional investor and there is debt, right? That otherwise you cannot have venture debt.
Yeah, rightly said. I think it is very much clear now that institutional equity is must for raising any venture debt from any of the venture debt fund actually. So this is one of the eligibility criteria. I will say that whenever anybody is approaching for venture debt. So there is another question from some other participant, which is for Mr. Pandey, Ankurji, that how about service-based companies? What is the thumb rule for VC funding for them actually? So
that
any
was
company
for working capital, right? I think I have answered
working
in
capital
chat.
for service-based company.
For trade and services, the thumb rule says maximum funding on working capital can be 15% of their net annual revenue.
Okay, I think
Then,
you already
but that is the
actually.
maximum funding. I have replied in chat as well.
Right.
Then there are multiple other factors which will be if you are collecting everything in advance and if there is no cash flow gap, then there will not be any funding on the working capital front from banks. So the banks fund working capital only when you have a mismatch in your cash flows, you have a gap in your cash flows, then only. So if you're receiving everything in advance, you're collecting all the payments in advance, or you're doing something which is a over-the-counter product you're selling, then there is no question of working capital, no funding from bank side.
Okay, very good. So I think one more question which is very important to discuss here. A lot of MSMEs are there, and the government has come out with a fund called SRI fund for MSMEs, where I think the venture debt or the venture capital funds are also getting money, the fundo fund. So what do you think any MSME company which is not defined any startup is approaching to any venture debt fund? Will it be possible for them to raise venture debt from these funds whenever they got any funding from these funds? Those have received SRI fund also, because as per the definition, they can fund to MSME companies only. So if you want to highlight on that, or if you want to comment on that, that will be helpful.
So from an SRI perspective, so largely what SRI has done is trying to do is that they are trying to help the MSME ecosystem, and all the startups largely fall under MSME definition. But from a venture debt perspective specifically, so when we talk about institutional capital, which Arijit and Aditya mentioned, it is largely from tier 1 VCs, which may or may not be backed by the SRI. So while this is a very broad definition, but it would be very case to case specific. So there won't be a generic answer to it. But what we can do is that if there are some names that can be looked at specifically, then definitely funds can take a call there.
Okay.
Yeah.
Anybody would like to add on that? Because this will, I think, more than 25 startup funds or the venture capital funds have raised money from the fund of SRI, and they have to deploy. The pressure is on the deployment side actually. So government condition is that it should be MSME. As Vivekji has rightly told, all startups are also MSME. But government want that typically, because for a startup there is a fund called CDB Fundo Fund actually. But this fund is mainly for MSME. So there will be pressure on the funds also to invest in the typical MSMEs also, although they must be having the meeting out the criteria for the investment from the institutional investor, but they'll not be falling in the startup category. So this will be the new opportunity for the venture funds also. I believe so actually. So if you want to add anything from your point of view, Arjit, or maybe Aditya, or maybe Ankit, it will be helpful.
Sure. We have actually, we are one of those funds which has raised capital from SRI as well as from the fund of funds. And from SRI, like you said, the criterion is SME investing. For fund of funds, it is startup investing. Now, the way these definitions, and I think unfortunately these definitions are, they've been set by the government from a wider perspective. These are not specific to how the venture ecosystem looks at these definitions. Especially SME, I think, is not something that the venture ecosystem has put any kind of thought process into how that should be defined. I think startups, there is still some kind of mutual understanding, but the government has very clearly defined there are certain criteria for startups. So, a lot of our companies would qualify as MSMEs. A lot of them would definitely qualify as startups, and they've actually gone and got the startup registration. We actually encourage our businesses to, whichever are qualifying, to apply for both, because there are a lot of benefits under government schemes, if they are actually applying for it. And SIDBI also asks for information from funds as to how you have participated in both MSMEs and startups, depending on the vehicle. And we provide that information. And I think generally the response has been quite positive, because SIDBI's requirement was that if they invest a certain amount, then the fund invests twice that amount. And we've been actually able to deliver on that. And I'm sure, a large number of the other funds have also been able to deliver on that.
Okay, great. So I think we have crossed our time limit also. Now we are having 5:20 actually. So I would like to end this session here. Note on that that there is a lot of demand and supply on the venture debt side actually, and this industry or this segment is growing very fast also, and a lot of startups are taking the advantage of it. And the one thing which has come out that the banks and the venture debt funds both are complementing to each other actually. So that's an important part actually, that banks are having very large pool of funds actually. So the startups, those are taking venture debt, they might be taking the bank funding also later on. So it will help in their growth also. And as we have shown in our presentation also, that as of today, the industry might be, this venture debt size might be $1 billion in the country. But over next 7-8 years or 6-7 years, we are hoping that it will be at least 10 times. So the growth prospects are very high actually. So as of today, we have had handfuls of funds, maybe 7, 8, 10 venture debt fund. But hopefully, maybe when we'll end after 6-7 years, there'll be more than 100 or 150 venture debt funds who will be operating in the country, and they will be complementing the banks also for the further journey for the startups actually. And the target of the government for reaching the $10 trillion economy in 7-8 years, I think it will be achieved through that also. So all venture debt will be contributing to the growth of the country also in a faster manner. So I would like to thank you to all the panelists for joining with us, for their time and the nice deliberation, giving the insights of their organization or their funding system. And I think we hope that the audience who is a part of this panel or this discussion, they must have get some kind of knowledge about the venture debt, how the venture debt is working, how they can raise money, whom they can approach at what stage also. So hopefully this will be helpful to all the participants, and they will approach to all the venture debt fund or to the SBI also for raising their debt actually. So once again, I would like to thank you to all of you for joining with us. Thank you all.
Thank you.
Thank you.
Thank
Thank you very much.
you.
Thank you, Ashish.
चलो भाई हो गया